Welcome to another edition of Inside the Economy. I'm Larry Howes. I'm going to talk about the labor market. There's a lot of drama in the media about the bad labor market, good labor market, whatever it is. We'll dispel some of that. Housing, some delinquencies or lack of delinquencies, what's going on in the stock market, and some important things on the energy electrical side and tariffs. I call it trade. It's the tariff conversation. And the numbers, not a lot of drama. Interest rates have dropped. The yield curve looks better. The first estimate for GDP in the second quarter, 3%. I was thinking 2.6, but it's better than that. It'll probably equate down, stabilize down, estimates down, that kind of thing over the next several months. But the first quarter was a data anomaly and a tiny bit of slowdown, nothing dramatic. Everything else is quite stable and performing very well. Now, the labor market really came out with, in fact, the head of the Bureau of Labor Statistics got herself fired over this. They wanted to correct some numbers and change this, so on and so forth. Irritated the wrong person. Missed point is the entire labor market since COVID has been adjusting back down. To where it ought to be. Relatively small new job creation, relatively small job loss, more stabilized, and it's getting there. It's basically there now. You can't keep creating 200,000 jobs a month. The job market is fine. The other side of the job market is the Employment Cost Index, the ECI, very important. It continues to come down. This is the total cost of employees, benefits, all that stuff. It is coming down because it got so high so fast, turned it into a freak show almost, but it is stabilizing, which is, if you have a lot of employees, very important. Their wages aren't going down. They're just not going to keep growing as fast as they have, and they're going to come down a little lower. So they're just back down to inflation, which we're still targeting at 2%. We're not there yet, but we're still targeting that. Federal government, I mentioned this before, acquired a lot of employees during the last administration, and the current administration is in the process of getting rid of them, which is important. These are all fairly well-paid white-collar jobs for the most part. They're just not helping. So they're going someplace else or retiring. I don't know what the deal is. What has showed up, however, is if you have a lot of white-collar jobs disappearing, you start seeing an increase in delinquencies in credit cards and car loans for people making over $150,000 a year. Interesting. Not very many of them. And you know delinquencies and car loans were very low to begin with, but it's popped up just in this income bracket. Well, housing has started to equalize itself. Prices are not plummeting. We don't have a bubble we have to take care of. Their rate of growth has dropped significantly, and they are stabilizing down a little bit, even in bad markets. And now Denver is considered a bad market. Austin is a horrible market, and there's a bunch of equally bad markets around the country. It means the prices aren't going up anymore. They're staying where they are, not plummeting. Supply has come back to normalcy. We've had much too skinny a supply market for too long. That's the old, you put your house in the market at 4 in the afternoon, you start getting offers at 6. Well, that's not a market, that's more of a racket. That is starting to clarify and get out of the system. We're back to a reasonable amount of homes sitting on the market, which stabilizes it and doesn't necessarily get a real fast super deal. Those days are probably over for the foreseeable future. Lowering interest rates is not going to help or particularly hurt that. I'll remind everyone, if you do lower interest rates and mortgages go from 6.7 to 6.4, well, that may make a house a little bit cheaper. It's also going to push the price back up. Not where it was, but it's going to push the price back up. Again, there's not a lot of reasons to lower interest rates. A lot of drama in the multifamily which is really an important real estate market right now, considering the number of large projects going on in Denver. There was a lot of drama saying, oh, delinquencies are really starting to shoot up, climbing into record territory. Well, this is sort of where that started. I'll point out to you, the top of the chart is 1% delinquencies. So they've gone from 0 delinquencies to 60 basis points, 0.6% in delinquencies. No, it's not bad news. It's just trying to communicate that market is equalizing too. Standard would be 0.5%, 0.75% of delinquencies in multifamily units. We'll get there. Revenue in the S&P 500 is good. Everybody but the energy business. Everybody's doing okay. Their growth in revenue is doing good. It has stabilized and justified the earnings in where the S&P 500 is now. Well, we were a little high. We're still a tiny bit high, but the S&P adjusted itself, corrected itself based on earnings, based on why you buy stock in the first place, growth and dividends. So we have a tiny bit more to correct down, and the markets will be just great. A lot of the tariffs are being resolved. As we've discussed, it's important they get resolved and they can be resolved quickly. The important one was with the European Union. We import a lot of stuff from them, and it's critically important that we do. Most of these people, it's important that we buy their stuff, but the EU was a very important one. That got resolved. Mexico still being discussed. I don't know what they're doing in Canada. China's really kind of negotiating. The one outlier here wasn't really important trading partners, India. They're liable to get big tariffs because they buy oil from Russia, which has proven to be very unpopular right now. So we'll see what they do with it. Those of you that aren't familiar with PJM, that's basically an auction house, clearinghouse for utilities to buy power. They buy it by the watts, by the gigawatts, whatever it is they do. And they just did the auction here of the grid's capacity for power. And electricity is going up. Cost of it went up a lot. They call it the AI boom. It doesn't matter what it is. The U.S. economy, in fact, the globe is becoming more and more dependent on electricity every day. AI is just the current use. It used to be electric cars, and that's proven not to be the case. But electricity is going up. Some of that is hopefully going into keeping the grid healthy. Some of that is probably going to help people get off the grid, and these big, large electrical facilities get on their own power source, which is becoming very popular. Finally, there's only a few people, I'm one of them, that care about this, and we've talked about the Fed's quantitative tightening. I love that term. Basically, that's the Federal Reserve that acquired a whole bunch of assets in 2008 when they were in trouble. We all remember that, 2008, 2009. They have been running all those assets off, and the assets they acquired in 2020 went way up. They've been running those assets off, letting them come to maturity, and the term is roll off. This is far and away another very important piece to the country's financial health, getting the Fed out of the bond business, and it's one of the reasons the yield curve is doing well, and the bond market is liquid and doing well, and the banks are very liquid. Even though their reserve requirements are being reduced, they still have lots of money. So accolades never go around to the Federal Reserve. It's more about complaints about why you're not doing this. The important job, and this is an extremely important job, they're doing very well. Okay, we don't have bubbles. We don't have issues. We don't have crises. The rest of these markets are doing fine. They're adjusting to where they should be. As always, send questions along to info@SHJ Wealth Advisors. I'm happy to deal with it. Thanks for joining me.